Folks, we have Tara Hardin with us tonight, and she is with the Kentucky Farm Business Management, and she's going to speak to us on, I guess, farm records and taxes or uh, that kind of thing. And Tara, take it away.
Thank you for having me. And I'm going to share this. All right, thank you for having me this evening. And like he said, I am Tara Hardin. I'm from Kentucky Farm Business Management Program. Just a little bit about myself. I work out of Elizabethtown, Kentucky. But me and my husband, we raise sheep in Meade County. And I'm just going to talk a little bit about some tax issues for the farm and also on the personal side of things, and what kind of records needs to be kept. Like I said, I'm going to talk about the program and just a little bit about the CFAP Ag program that came out from the USDA office back in 2020, and also the when COVID hit. And then also with the payroll protection program, and just a little bit of tax review at the end of things. Just a little bit about Kentucky Farm Business Management Program. We cover all of the state of Kentucky, even though down there Lincoln Trail only shows a little bit of the eastern half of the state. I actually cover everything east of E-Town and all the way up to northern Kentucky and also south central Kentucky. Lincoln Trail Association is the largest association in the state based upon the number of counties that I serve. Yes, the western part of the states may have more of the farms and more of the large acres, but I cover most of the state. Most of the farms within Lincoln Trail Association are smaller producers and a little bit more diversified. And you'll also have more of the part-time producers that also have W-2 wages as well as farming. What we kind of do is we help with the records, like I'm going to talk to you about tonight, not only with tax records, but also more on the production side of things and the financial management, using those records to make good, sound business decisions. We also look at enterprise analysis. Where are you losing money? Are you losing money on your cattle? Are you losing money on grain? We try to figure that out for you and help you along with that and make some good decisions that way as well. We also help with lenders. If you work with a local bank, we help you put together an end of the year balance sheet, income statements for your farm, and help. Like I said, it all goes back to making these good, sound decisions, both production side of things and also financially. And we also help with tax planning and helping you get good tax records to your CPA, to your tax preparer, and help that go a little bit quicker for everybody. Jumping into the CFAP, most of you are aware that CFAP 1 and 2 was mainly crops and livestock, and that happened back in 2020. Most farms in Kentucky got something. Some got more than others based upon what you had. And it covered pretty much all species, from goats and sheep to your cattle, your dairy. And CFAP 2.1 kind of rolled out, I guess, in mid-February. They said that, we have some extra funds. No, it came out, December. And then in February, it got this regulatory freeze pending review. Essentially, the new administration said these funds, they might not need to go towards these producers. It is still under review. However, people can sign up if you qualify for it. Not everybody will get this money. When they went to CFAP 2.1 under review, they also said CFAP 3, which is mainly for cattle and your row crops. They put that also under review. Now, granted, for 2.1, you can still apply. The CFAP 3, no additional information has been set out. However, there has been rumors that, what's it going to pay per acre per head? However, nothing's been set in stone. We thought we might have some more information by now on these two programs, but that just hasn't happened yet. With all of the government payments that came out in 2020, you had the last payment of the MFP program in 2019 came in January of 2020. And then you had the CFAP payments, and then also your regular ARC and PLC payments too in October, and a few got WIP programs. All of this government payments, from what we have seen in KFBM, tax planning was crucial this year, just because that money was kind of extra on top of what is typically sold for the year. So for some people that caused some tax planning issues there at the end of the year. Maybe you push some crop or push some livestock sales into 2021 that they typically wouldn't do to help mitigate that. But just a little observation from the firm records that I see. Now, jumping into the payroll protection program that was rolled out at the start of, I guess, a year ago this month, really. This SBA is an SBA program, a small business administration program. And there's been some changes back in December. So when it was first rolled out in March of 2020, it was based upon number of employees and your wages, and your net farm income on your Schedule F had to be positive. A lot of farmers in the Lincoln Trail Association did not qualify for the round one payments that opened a year ago. The main reason for that is because they don't have employees. Most of their sole proprietors didn't pay themselves wages, so they didn't qualify. And so it really wasn't reaching the farming community as wide as what they thought. So in December, they came back and said, we're going to adjust the round one rules and qualifications to make it to where you were the farmer, a sole proprietor, only had to show on a Schedule F a positive gross returns. So that meant everybody is qualified for the payroll protection program, no matter how big or small you are. As long as you had as long as you sold something, you are qualified for this program. The maximum amount that a producer can, or any small business for that matter, can get qualified for is that $20,833. You do not have to be at that $100,000 gross revenue in order to be qualified. You can have $10,000 worth of revenue, $5,000, any amount. It just has to be positive. And that's one of the main misconceptions about this program, that smaller producers say, well, I'm not a big farmer. I mean, I'm not a big business. I'm not a big farmer. It doesn't matter. Anybody can qualify for this. And they also sent out a round two, and we'll talk about that as well. If for a producer, for the round one, if they've received it and it has already been forgiven, they go on to round two. And then if you have not received round one, then you can qualify for a round one draw. And then round two, or a second draw, if you already received the first and it's been forgiven, you're going to compare quarters to in 2019 versus 2020. So first quarter versus first quarter, second versus second. And if any of those quarters throughout the year is below 25%, then you qualify for this round two draw. Like I said, most everybody that I've talked to, especially within our area, is just not qualifying for that round one. So they will not be able to get round two based upon time restrictions needed to get these loans forgiven. One of the good things that happened back in December was that the forgiveness of these payments were simplified. So it's easier to apply for these loans, and it's easier for these loans to get forgiven. The deadline for applying is March 31st, or when funds run out. From what I'm hearing, there's still funds out there for this program, and it's easy to get applied for. Most, you just need to contact your local financial institution that you use. It is a simple one-page application. If you can do the second round, you'll just need to show 19 versus 20 in your Schedule F. And most producers, once that application is submitted and the bank has your funds, you'll see that within your bank account within a week or two. So it is fairly easy to get. One benefit of this program is that you are able to fully deduct the expenses that you use. And you also, the income, the forgiveness of these payments is not taxable. So it's a win-win for small business, for small businesses. You don't have to pay income tax, and you get to deduct it on your taxes. Normally, that's not the case, but this is what Congress and the government has chose to do for this program. Going towards a tax update, and I'm going to try not to bore everybody with this, is here you see the tax brackets from compared 2019 to 2020, and it's mostly adjusted just for inflation. That small difference between the brackets. Nothing has changed with the brackets. They're still the same as last year. Just a little bit difference on the maximum amount on the top side. Filing season. I know everybody's probably geared up to file their taxes if you haven't already done so. The IRS started accepting applications a month later than normal. Under normal circumstances, even though I'm not for sure if we all know what normal is anymore. They delayed that to February 12th. However, they still kept the March 1 and the March 15th deadline that many farm producers qualify for, that have to be filed for. However, if you normally have to file before or on April, the normal tax deadline, April 15th, it is now May 15th. They pushed that back a month later. Last year when COVID hit, they pushed it back until I think June or July. This time they just gave us a month. However, even though you don't have to file until May 15th, they gave you that extra month. if you owe anything to the IRS, you still have to pay before or on April 15th. That's just kind of one of the kickers. Even though they said no, you don't have to file till then, they still want their money before or on April 15th. Everybody kind of knew that they might extend this deadline just because of the fact that with all the new stimulus money coming out, the new tax changes that happened right at the end of the year in 2020 with that with the COVID relief bill that passed on December 27th, it really did not give the tax software that the IRS uses and also the tax software that your CPAs and you use to file your taxes time to adjust. So we saw that delay at the beginning, which ultimately kind of signaled that yes, it may be delayed at the end as well. Right now, you're still seeing a delay, as most of you have probably heard. They're still sometimes they're still working on 2019's returns, processing them. So it's taking them later to get to 2020 returns. So, which ultimately says that you're probably going to see, if you get a tax refund, that is also going to be delayed as well. And I know this week they said that they passed the bill for the stimulus, and they said that stimulus payments, the third round, will be in, I guess, most everybody's bank account by the end of the week and into next week, and then start printing checks and sending out cards. The third round is $1,400 per individual. That's individual and dependents. As you see on the screen, you have the round 2 and the round round 1 that came out. One of the significant also changes in round 3. There's a lot of changes, a lot of money that kind of shift hands. But one of the things is the increase also to the child tax credit as well. They increased it by $1,000. Now, most people have said, you know, I didn't receive my first round, I didn't receive my second round, or I received partial but not all of it. That's okay, because when you file your taxes with your CPA or yourself, if you do them yourself, there are going to be a spot on the computer program that says, how much did you actually receive through your bank account or through a check that they mailed to you? You need to know that before going in. So if you receive the full amount, you're going to write in the full amount. If you only received $1,000, write in the $1,000, and then the rest is going to be credited onto your tax return for 2020. And you will see that, and your refund will be higher a little bit. It is not taxable income. It is just a credit that they have given in the form of cash before you file your taxes. But you will need to tell your tax preparer how much you have received, because the computer softwares do not reconcile that internally. Now, kind of switching gears to farm records. And this all kind of keeps going back to taxes a little bit. And also production, because you want to know that information too. But gearing more towards taxes to help the process go smoother, not only for your CPA, but for you. You need to keep of course, all your receipts from your sales, livestock, grain. If you do farmers markets, keep all of those sales. Do vegetable production, greenhouse. I mean, if you sell plants, keep all those sales, keep all the receipts, hopefully organized in some form or fashion. And then also keep your 1099s and 1098s from the mortgage companies or co-ops like Southern States. That's all going to be beneficial to help the process go smoother for everyone. One of the things too is when you're doing the financial side of things, you'll want to make sure that you have all of your loan information handy. That way, when you complete a year-end balance sheet, that is easy to find and to give your lender if you have extra loans out there. I'm going to kind of jump down to that bottom bullet. Even if you paid in cash, keep that receipt and pay it in cash because it's totally deductible. I have many clients that like to take out, $200 just so they can, pay $50 here or pay some extra labor with that cash. Tell your CPA, it says withdrawal of $200 from the ATM. Tell your CPA, hey, that was for labor. Don't forget those expenses that you might have paid with cash within your pocket. And this kind of goes back to make sure that you're organized, that you keep accurate records. Not only for your taxes, but to better know your operation. Where's the money coming from? Where's it going out? Am I spending too much on machinery repairs than what I should? How does what I'm doing now compared to my budget that I have put together for this year? Access to capital. Most financial institutions are wanting a balance sheet, wanting to see what your assets are, what your liabilities. And then also, of course, your tax planning and filing taxes. It's all going to make it easier on you if you do this throughout the year. And there are different programs that can help you keep this organized. The main thing with farm records and with filing your taxes is organization. Little things can make it go smoother for everybody. Now let's talk about hobby farming. I know a lot of people start getting kind of worried that the IRS may audit them or come look at them just because of the fact that maybe both husband and wife, they both have off-farm income, W-2 wages, but they also farm a small portion on the side. And everybody's wondering, gosh, is this going to be considered a hobby farm? Is the IRS going to come here and look at, I'm running a loss the past 3 years completely, even though I've tried to make money and that's the goal. Everybody knows that's the goal, but on a Schedule F, it just doesn't look good. As long as you keep those records that we talked about, you're fine, especially when you're starting out in a farm operation. Typically, those Schedule Fs are going to be negative because you're going to have more startup and more expenses than you will income coming in, especially at the beginning. But hobby farming is just doing it for fun. I don't know too many people that have a hobby are just, yes, you might get pleasure out of farming and you might like it. You might like those long tractor drives or cutting the hay just because that's kind of one of your favorite activities on the farm. But everybody's doing it because they're making a business out of it. They want to make the money and show a profit. And these, I think there's 9 that the IRS has said, you have to be engaged in most of these to be considered not a hobby farm. So how the activities carried, experience, time and effort, assets. So owning equipment or owning buildings, history of income and losses, show an occasional profit, financial status. As long as you are engaged in most of these, which most people are, because you're going to spend a lot of time and effort in your farm, even though you have W-2 wages. Both me and my husband work off the farm. We farm from the hours of 6 at night to midnight, especially in our month when we start lambing. So as long as you have reasonable expectations and can tell the IRS if you do by chance get audited, you shouldn't have a problem showing your tax returns, keeping accounting, if you have an accounting software or spreadsheets, if you're keeping records, this all helps build your case that, hey, no, I'm not in this for a hobby. I run this like a business. And that's pretty much all you have to show. General rule of thumb is determination is based upon facts and circumstance. So go back to the previous slide. As long as you can show them, hey, I have books, I have production records, I can show you what I'm doing on the farm and I can explain it. Yes, my Schedule F may be negative for the past 2-3 years. However, I'm doing everything that I can to market my farm inputs. And the taxpayer bears the burden of proof. So the taxpayer ultimately has to show the IRS or the auditor, hey, this is my records. And like always, it's critical to make a timely response to the IRS if you do get audited, and also just have that documentation, like we've been saying from the start of this hour, is as long as you can show the documents, keep them organized, you shouldn't have a problem. I will say that audits for hobby farms and the smaller farms, I know in the past year, have slowed down. The IRS just doesn't have enough auditors, to be quite honest, to audit tax returns and businesses like they have in the past. And this was even before COVID. And now once COVID hits, the IRS is really lacking on their staffing on certain aspects of things, whether that be accepting tax returns, audits, answering questions about the tax forms. So things have kind of settled down on the audit side of things. One thing I left off of this slide is not every auditor is going to know about farming practices. More than likely, you'll spend more time telling them about farming rather than spending time going over documentation. From the past audits that I've been a part of, you're doing a whole lot more explaining of farm operation than you are about the actual business. At the beginning, we talked about tax planning, talking about how we got all this extra government payments, that we might have a tax issue that we normally don't have, or we normally don't have to plan for. So when we talk about having high farm incomes, some of the ways that we can lower that farm income to lower that tax liability is, if you get any disaster payments, you can defer that to 2021. You just have to, you can, if you buy equipment, make major improvements to your land, fencing, building new roads, new fencing, new buildings for your operation, you can slow down that depreciation. And instead of a 5-year life on your depreciation schedule, you can max it out to 7 years, some buildings to 15 to 20 years. So you can stretch that out to help lower your income. Reduce or limit all prepayments of expenses. Not prepaying for fertilizer, even though it's gone up, and it would have been better to do it in December. Contribute personally to a Roth IRA. That's one of the things that I've been trying to get more of my farmers to do, because most of them don't have a retirement account. So investing in a Roth IRA is one way to lower your income. Then you have your CC loans. If you have any of those, the commodity loans out of FSA, you can also take that as a loan rather than income. One of the things that happened for equipment sales and purchases and trades, I guess it's almost been 2 years ago, maybe even 3 years ago, that people still are kind of thinking about the old way, the old IRS code, like kind of exchanges. Well, if I trade in tractor X for tractor Y, then I have my basis that I put on my depreciation schedule is actually the difference. That's not the case. There is no more like kind of exchanges. That means if you sell tractor A, sorry, let me back up. If you trade in tractor A for tractor B, that is now 2 different transactions rather than just one. Even though on the paperwork from the equipment dealership, it's just one transaction. When you talk about taxes in the IRS, it's 2 transactions, and that's what kind of gets people confused. You now have a sale of an asset and then a purchase of an asset. So for most people, that actually kind of works out better. And there's different tax strategies that you can use with that new purchase to help lower any additional profits that you may have gotten from selling that tractor. And that's something that your CPA can kind of dig into on a one-on-one basis, of which will help you better. But that is now 2 separate transactions rather than just one. Another thing that most people don't kind of realize is that when you sell livestock, when you sell those cull cows, you need to know if they were raised on your farm. So were they born on your farm? Or those cull cows, did you bring those all the way up? Or did you purchase them from a breeder, from a stockyard? You need to know that information because they are taxed differently when you sell them. And that is for all breeding stock that you sell, whether it be cull cows or bulls. Did you purchase them or did you raise them? Purchase will come off of your depreciation schedule. Hopefully that you took a good notes that you can kind of match those up. If you raised them, it is considered capital gains when you sell them. Market stock, if you're selling calves, you're kind of holding them for sometimes, depending on your marketing schedule and how you do it, you're selling them less than a year, short term. And then long term is mostly your bulls and your cull cows. If you raise those, that is going to be considered long-term capital gains. And your long-term capital gains bracket is there for you to look at. So you can kind of see if your income is in that 0 to 80,000 mark, then you're not going to have any capital gains on those sales. And then it kind of goes up to 15. Not too many are going to hit that 20% unless you're a really big farmer. Depreciation. Most people know what Section 179 is because at the end of the year, especially more towards central Kentucky and especially out western Kentucky, they'll buy that tractor, that piece of equipment towards at the end of the year to lower their taxes and then take Section 179 to expense it all. So you see those levels there on your screen, and each year at 2020 it's over $1 million. 2021 it will be $1,050,000. It is very hard for farms in the Lincoln Trail area to hit that limit. Most of them are going to be allowed to take Section 179 expense on all of their purchases if they would like, if that is what the best tax planning and tax strategy is for their operation. Another kind of tool in the toolbox when it comes to depreciation is bonus depreciation. And right now, as it stands in 2023, that is going to go away unless Congress brings that back. And that's just, like I said, it's another tool in the toolbox for your CPAs to help with your equipment and your income. I just kind of throw this in. It's kind of one of the questions that gets asked, not often, but here and there, is about estate tax. There's been quite a buzz around how estate tax is going to be in the next year with the new administration. So as of right now, you can see the past 3 years. It's gift tax and state tax exclusion for 2021 is 11.7 million. And like in past years, is for surviving spouse, can add up the unused portion. So that can be higher depending upon the situation. And then the annual gift exclusion is $15,000. Just kind of for your reference, not everybody's going to care for about this, but it is just one of those things that some people like to know and like to look at, especially since, like I said, there's kind of been a buzz about how this administration is going to treat estate tax in the future. And then here is my contact information. Like I said, I am here as a resource to farmers and all across the Lincoln Trail area, which reaches from Hardin County all the way to northern Kentucky, down to south central Kentucky, and all the way in your area. So if I can ever help you in anything, whether you have a tax question or production question about farm records of any sort, please contact me. I am here to help you and to also help your ag agents as well. Thank you.
Tara, thanks so much. I've got a question.
Yeah, go for it.
We often get questions from folks that call the office or come in, that are clients that may have done, some extensive gardening in the past, but then they want to step it up a notch.
Mm-hmm.
Whether it be in gardening or beginning to raise cattle or whatever. What do you recommend for these people? A lot of times I'll say, they'll ask about the taxes. They ask about the tax question. And a lot of times I'll say, well, go see your CPA. And, when I find out they've not really been going to a CPA, they've just been going to a tax preparer. But what would you recommend for these folks that really want to take that next step or are interested in getting into a farming type business?
The first kind of thing that I always say is there's always resources, especially out there, like, with UK Extension. You have the crop diversification program that has been good. I've sent several people there because of the horticulture production type of aspect of it. They have great budgets for that and can walk people through taking that next step on the horticulture side of things. And then they have come back to me kind of saying, okay, this is kind of what I've got from crop diversification. What do you see? How can my current financial standing, can you help me put together that balance sheet? Because I may need additional funding. So that's kind of where I kind of step in that sense that I kind of know how to put together the financials that need to be made, and then kind of go from there. And also, look within yourself, like, how much am I willing to risk? Farming's all about how much risk you're willing to take. So look at your balance sheet. Look, how far deep in do you want to get, so to speak?
Okay, sounds good. And, and maybe kind of along those same lines is that person who has never filed that Schedule F. And, I get that question, and I'm sure Shay get that question from time to time about the person of, they hear about tax breaks, and that sort of thing.
Yeah, I mean, you have to start somewhere, and that's kind of always what I tell, especially some of my new farms. You got to start somewhere. So even if you, by chance, just one year say, okay, I have this vegetable garden and it's not big, it's not not too terrible. But if you have dreams and aspirations of, becoming a larger business, go ahead and file that Schedule F, even if it's small. It doesn't, personal experience when my husband and I were starting our business, we just had 3 U's. That's all we had. Now we have 200. But also had the knowledge and the background to go ahead and file that Schedule F. We didn't have any income. The expenses were crazy. But you do have to start somewhere. And the IRS isn't going to track you down if you file a Schedule F 1 year and not the next. Things happen, life changes. But there are programs out there. So filing a Schedule F shouldn't be a deterrent, so to speak.
Okay, cool stuff. And we ran into that stuff quite often.
Yeah, you can file a schedule. If you consider yourself a farmer and you meet the qualifications that the IRS sets out for you to be able to schedule or file a Schedule F, go for it.
Heather's asked a question in the chat box. Heather, you can unmute and ask.
Well, somebody was being loud in the background. I was afraid if I unmuted, he'd start squalling. Tara, how long do we need to retain records that we've kept for our tax purposes?
So the IRS says that they can go back 3 years. So tax returns are 3 years. However, I always say go 1 or 2 years before that. Go, do the 5-year plan. Because most of the time, I don't know how you guys are with your farm records. You'll want to just, what happened in 2019 or 2018? So my suggestion is the 5 years across the board, whether that be for any type of loan documents, production records, tax records, keep all your 1099s, your W-2s. I say 5 years is a great number to go with.
Thank you. And one other, I guess, kind of question.
Yeah.
What about these gas receipts that after about 6 months, they have faded off? I know ideally, we should have some sort of scanner and uploading that into something to preserve that. But say we didn't get that in year 1 and year 3, they audit us and you can't read half of the gas receipts.
So that's kind of what I say. You really need some sort of record keeping system, whether you're putting it into an accounting software like QuickBooks, or just each month putting those receipts into a Excel file. When the IRS, they come out and they look at these audits and they see these gas receipts, if they can't read it, they can't ask about it, to be quite honest. But if they can make out a little bit and it matches up to the information that you have entered on a Excel spreadsheet or QuickBooks, that is all fine.
Thank you.
Heather, you can use your cell phone. There's a scan feature in the notes. So if you wanted to, you can create files on your phone and just scan the receipts and store them that way.
Okay. Thank you, Shad.
Tara, I have another question.
Yeah.
It's concerning a newer type farmer. When it comes to say, this is why I send people to their CPA or to a CPA. And I think it's important that somebody goes to a CPA that has an idea about businesses and farming. Like you said, a lot of times people sit down, spend most of their time explaining what a farming business is like. But what if somebody who had went and bought a piece of equipment, whatever it may be, they built a barn, and then 3 years later, they decided to go into this business full-fledged, start filing, Schedule F, so on and so forth. can they go back and start depreciating on that, or do they need to just begin depreciating then, or is that even out of the question?
That becomes a little bit on the hairy side of things.
Okay.
There are, and I hate to say this, all CPAs are going to treat that a little bit different.
Okay.
That's why I kind of say don't be afraid, even if you are a small producer, if you're building that farm, if you're building that barn and you have some type of income and some type of expense, go ahead and start filing that Schedule F and get that on your depreciation schedule. That way it's not coming and back and kind of biting you in the butt 3 years later. With that being said, you can always amend returns up to 3 years. So, if you see an issue or, something, say you got an insurance claim on a barn that fell down, you can go back and amend it. So there's different tools in the toolbox to help with that situation. And it's going to have to be on an individual case by case. What's the facts and the circumstances about how it was handled.
Gotcha. Okay.
And it is hard also to find knowledgeable CPAs that know farming, just because of the fact that we get different rules than even regular businesses. So that is kind of one of the difficulties, and that's across the board about finding CPAs or an enrolled agent, a tax preparer that understands how farming and how you have to file that return.
True. Okay. And one more, and I'll try to hush, but another one is, I've gotten the question before or gotten the comment of, well, now that I'm going into farming, I need to set this up as a corporation or as a file as a corporation. And I tell them they do not have to do that. Correct? They can go ahead and file that under their own Social Security number under a Schedule F, and they'll be okay.
Yes, that's perfectly right. You don't, just because you have a farm doesn't mean you have to be incorporated in LLC as an S Corp or a C Corp. And sometimes that is not the best for everybody. Yes, the easiest way if you're just starting out is go ahead and just file a Schedule F under your personal Social Security number and go with that. And then if your business gets complex and you have different avenues, you say you have a trucking business and a farming business and you want to keep those separate, then yes, it may be in your best interest to form some type of entity, whether it be for the farm or for the trucking. So yes, just file that Schedule F. It's the easiest once you get into it. Once you get larger and you have different businesses, then you can kind of talk about forming these different entities. And with that, I would say not only have a good CPA that can set these up correctly for you, but also talk to an attorney to make sure that you have the right documents as well.
Gotcha. Okay. Thank you. Good information. And that's, and I've talked to people who, who've set up with, different corporations, whether it be farming or non-farming, and I know that it gets expensive. And so if you're small, I understand not need to get into the expense of things. So cool.
Yes, one of the things that most people don't understand is that it's to form a business, an entity, an LLC or partnership, there is cost to it. It's not just as easy as telling your tax preparer, oh, I want to schedule, I want an LLC this year. It's not that simple.
Right. Great information. Thank you.
Any more? Okay. Tara, thank you for taking the time to be with us and to give us a thorough rundown of taxes, and we appreciate you very much. Jeremy, what do we have coming up, I guess, next week?
Next week, I think I'm going to hand that off to Phil because I know Phil's covering both of those, I think, next week. So I'm going to hand that off to him.
Oh, very good. He's going to make us hungry.
Well, I think if I've got my dates right, I think we've got cut flower production and marketing on Tuesday by Susan Cheek from Virginia State University. And on Thursday, we have Sharon Rice talking about the Mediterranean eating pattern. So that's what's coming up.
Okay, very good. I'm looking forward to both of those. Okay. Well, thank you all for tuning in. And if you have any subjects you'd like us to cover, just call Phil. He'll get those scheduled. And he's the one that does the most interesting topics. But we look forward to having you with us next week, and hope you all stay safe.
Thank you, Tara.
Thanks, Tara.
Thank you all very much.